Most people believe successful investing is complicated. They imagine experts studying financial reports late into the night, traders watching markets every minute, and professionals making endless calculations to find the next winning stock. The world of investing often appears filled with confusing jargon, complicated strategies, and constant predictions about what will happen next. For the average person, this can feel overwhelming. After all, most people already have enough responsibilities. They have careers to build, families to support, bills to pay, and dreams they hope to achieve. They do not want to spend hours every day analyzing stock charts or worrying about market movements. They simply want a reliable way to grow their money and create a secure future. What if investing did not have to be complicated? What if building wealth was less about making brilliant decisions and more about following a simple system consistently over time? This idea may sound almost too simple to be true, yet it is supported by decades of evidence. Some of the most successful investors are not the people making the most trades or chasing the latest opportunities. They are often the people who understand one powerful principle. Wealth is built through patience, discipline, and allowing time to work in your favor. The modern financial world constantly encourages action. News channels demand attention. Market commentators make bold predictions. Experts argue about where stocks will go next. Every day seems to bring a new reason to buy, sell, panic, or celebrate. Yet beneath all this noise lies a surprisingly simple truth. The greatest fortunes are often built not by those who constantly react to the market, but by those who create a sensible plan and stick with it through good times and bad. This audiobook explores that truth through one of the most powerful investing tools ever created, the index fund. You will discover how ordinary people can participate in the growth of businesses around the world, benefit from the power of compounding, reduce unnecessary risks, and build long-term wealth without turning investing into a second career. More importantly, you will learn that successful investing is not about predicting the future. It is about creating a system that works regardless of what tomorrow brings. And perhaps the most surprising lesson of all is this. Sometimes the investor who does the least ends up achieving the most. That may sound impossible in a world obsessed with constant action, but as you are about to discover, one ordinary investor proved exactly that. His story reveals why simplicity often beats complexity, why patience can outperform brilliance, and why doing less can sometimes lead to far greater results. So let us begin with a remarkable story, the story of the investor who did nothing and won. Chapter 1. The Investor. Who did nothing and won? There is a story that does not get told enough in the world of finance. It is not the story of the genius trader who woke up at 4 in the morning, stared at glowing screens, drank 3 cups of black coffee before sunrise, and somehow managed to predict the exact moment the market would move in his favor. It is not the story of the hedge fund manager who wore a tailored suit and spoke in numbers that made ordinary people feel small and confused. No. The story worth telling, the one that quietly changed the financial lives of millions of people around the world, is the story of the investor who did almost nothing and still came out ahead. Imagine a person, let us call him Daniel. Daniel was not particularly interested in the stock market. He did not read financial newspapers every morning. He did not follow the careers of famous investors with religious devotion. He had a job, a family, a mortgage, and a life that was busy enough without adding the burden of studying quarterly earnings reports. But Daniel had one thing that many people overlook. He had patience, and he had a simple system. Every single month, without fail, Daniel put a fixed amount of money into a fund that tracked the overall performance of the stock market. He did not try to pick the best stock. He did not try to time the market. He did not hire a financial advisor who charged him a percentage of his savings every year. He simply let his money sit in this fund, and he went back to living his life. 20 years passed, and when Daniel looked at his account, he discovered something remarkable. His money had grown in a way that most active investors, people who had spent thousands of hours studying charts and making careful decisions, simply could not match. He had outperformed the majority of professional money managers, not because he was smarter, not because he worked harder, but because he had understood something quietly profound. In the world of investing, less is very often more. This is the world of index funds. And this audiobook is going to walk you through every corner of that world, in plain language, with no assumptions about what you already know, and with a clear focus on giving you something real and useful that you can carry with you long after this last chapter ends. But before we dive deep into the mechanics, before we talk about how these funds actually work, and before we explore the strategies that can genuinely change your financial future, we need to ask a very simple question. A question that almost every beginner investor asks quietly in their head, but sometimes feels embarrassed to say out loud. Why is investing so confusing to begin with? The answer to that question is the true starting point of this journey. Because once you understand why the world of investing feels complicated, you will begin to see why index funds cut through that complexity like a sharp blade through fog. And once you see that clearly, everything else in this audiobook will make sense in a way that feels almost like a relief. So let us begin there. Let us begin with the noise. Chapter 2. Why the world of investing feels impossible. Turn on any financial news channel at any given moment, and you will be confronted by a wall of numbers moving up and down, voices speaking with urgent certainty, and a general atmosphere that suggests the world is either about to collapse or about to experience an unprecedented boom, depending on which guest happens to be speaking. There are tickers scrolling across the bottom of the screen. There are red arrows pointing down and green arrows pointing up. There are interviews with people in expensive ties using words like liquidity, yield curve inversion, quantitative easing, and forward price to earnings ratios. If you are a regular person with no background in finance, this environment does not invite you in. It intimidates you. It makes you feel like investing is something meant for a very specific type of person, someone who was born understanding these things, or someone who spent years in a university learning the language of money. And that feeling, that sense of being locked out, is not an accident. The financial industry has, for a very long time, benefited from complexity. When investing feels complicated, regular people hand their money over to professionals and say, "Please, you handle this." And when professionals handle your money, they charge you for the service. Sometimes those charges are clear and visible. Often they are not. They hide inside something called expense ratios, management fees, load fees, advisory fees, and a dozen other labels that add up quietly over years and decades until they have taken a significant portion of the growth that your money could have generated for you. This is not to say that everyone in the financial industry is dishonest. Most people who work in finance are doing their jobs the best they can, but the structure of the industry creates a powerful incentive to keep things complicated, because complexity justifies the fees, and the fees are how the industry makes its money. Now, here is the truly fascinating part. Study after study, conducted over many decades, across many different markets and many different economic conditions, has shown something that should make every person who pays high fees to a financial manager sit up straight in their chair. The vast majority of professional fund managers, people who are paid very well to pick the best stocks and beat the market, do not actually beat the market over the long term. Most of them, when you measure their performance over 10 years or 20 years, after accounting for the fees they charge, have actually delivered less growth than the market itself would have provided if you had simply invested in all of it at once. Read that again, because it is important. The people we pay to do better than the market, most of them do not do better than the market. And after their fees, many of them do significantly worse. This raises an obvious question. If the experts cannot reliably beat the market, who can? And the answer, the beautiful and slightly subversive answer, is almost no one, consistently, over long periods of time. Not because the market is impossible to understand, but because the market is the collective result of every single buyer and seller making decisions at every single moment. And that collection is extraordinarily difficult to outsmart on a reliable and repeating basis. This insight is not new. It was articulated clearly and powerfully by an economist named Eugene Fama, whose work on what is called the efficient market hypothesis won him a Nobel Prize. The basic idea is this. The price of any stock, at any given moment, reflects all the available information about that stock. Because millions of informed, intelligent people are constantly buying and selling based on everything they know, it is extremely difficult for any single person to consistently know something the market does not already know. There are exceptions, of course. There are periods of time when individual investors do beat the market. There are funds that have outperformed over certain stretches. But the key word is consistently. When you study the data across long enough time horizons, the picture becomes clear. Consistent outperformance is extraordinarily rare. And most of the people who claim to have found the secret to beating the market eventually prove that what they had was luck, not skill. So where does that leave the ordinary investor? The person who does not have a degree in finance does not want to spend hours studying charts and simply wants their savings to grow in a meaningful way over time. It leaves them exactly where Daniel found himself, standing in front of a solution that is so simple it almost seems too good to be true. A solution that says, if you cannot reliably beat the market, why not simply own the market? That solution has a name. It is called an index fund. And the next chapter is going to explain exactly what that means, in the clearest possible language, starting from the very beginning. Chapter 3. What is an index and what is an index fund? Let us start with the word index because it is the foundation of everything else. An index, in the context of the financial world, is simply a list. It is a carefully constructed list of companies or assets that are grouped together according to a specific set of rules. The most famous of these lists is probably one you have heard of, even if you did not know exactly what it represented. It is called the Standard & Poor's 500, which most people simply call the S&P 500. The S&P 500 is a list of 500 of the largest publicly traded companies in a particular country's stock market. The companies on this list represent an enormous range of industries. You will find technology companies on this list. You will find healthcare companies. You will find financial companies, energy companies, consumer goods companies, and dozens of other industries that together form a broad picture of the overall economy. The index does not just pick 500 random companies and leave it at that. The weight of each company in the index is determined by what is called its market capitalization, which is simply the total value of all the company's shares. So a very large company will make up a larger portion of the index, and a smaller company will make up a smaller portion. As companies grow or shrink, as new companies enter the list and old ones are removed, the composition of the index changes automatically, according to the rules. Now, here is where the index fund comes in. An index fund is an investment vehicle. It can take the form of a mutual fund or an exchange-traded fund that is specifically designed to replicate the performance of a particular index. If the index goes up, the fund goes up. If the index goes down, the fund goes down. The fund does this by buying shares in all, or a representative sample, of the companies that make up the index. This is very different from what a traditional actively managed fund does. An actively managed fund has a manager, or a team of managers, who are constantly making decisions about which stocks to buy and which to sell. They are trying to outperform the index to do better than the overall market by making smarter choices. An index fund does not try to do this. It simply follows the index passively, automatically, without anyone sitting in a room making judgment calls. This passive approach has a very important consequence. It costs much less to operate. Because there is no team of researchers and analysts constantly studying stocks and making decisions, the fees charged by index funds are dramatically lower than the fees charged by actively managed funds. And as we will see in later chapters, that difference in fees, even when it seems small on the surface, has an enormous impact on how much money you end up with over long periods of time. There are many different types of indexes, and therefore many different types of index funds. Some track large company stocks. Some track small company stocks. Some track international markets. Some track bonds. Some track specific industries like technology or healthcare. Some track the entire global stock market all at once. The variety is genuinely wide, and that variety gives investors the ability to build a portfolio that suits their specific goals and circumstances. But for most people, especially those who are just beginning their investing journey, starting with a simple fund that tracks a broad market index is not just good enough. It is, according to the evidence, one of the best investment decisions a person can make. Because broad market index funds give you something that is incredibly difficult to achieve through stock picking or active management. True diversification. Diversification is a word that gets used a lot in finance, but its meaning is simple. It means not putting all your eggs in one basket. When you own an index fund that tracks 500 different companies, you are exposed to the success of all 500. If one company fails completely, it barely affects your total investment. If one sector struggles, the other sectors may be doing well. Your portfolio is spread across the whole economy, not concentrated in a handful of bets. This spreading of risk is one of the foundational principles of smart investing. And index funds deliver it automatically, effortlessly, and at very low cost. You do not have to think about which companies to include. You do not have to monitor the list and make adjustments. The fund does all of that for you, following the rules of the index it is designed to track. This is the genius of the index fund. It takes a complicated world, the world of investing in individual stocks and managing portfolios, and it reduces that complexity down to a single, manageable, low-maintenance decision. You buy the fund, you hold the fund, you let time do its work. But to truly appreciate why this works, you need to understand something about how markets grow over time. And that is the subject of the next chapter. Chapter 4. The History of Markets and the Power of Long-Term Growth. Human beings have short memories when it comes to money. We tend to remember the most recent experience most vividly. If the market has been rising for the past year, we feel confident and want to invest more. If the market has been falling, we feel afraid and want to pull our money out. This psychological pattern, reacting emotionally to short-term movements, is one of the most reliable ways to damage your long-term financial results. To understand why index funds work so well, you need to step back from the short-term noise and look at the long view. The very long view. Stock markets, despite all their volatility, all their terrifying drops and exhilarating rises, have shown a remarkably consistent pattern over very long periods of time. They go up, not in a straight line, not without significant setbacks along the way, not without years and sometimes even decades of difficult performance. But over sufficiently long time frames, the trend is unmistakably upward. Consider the broad history of stock markets in developed economies over the past 100 years. This period included 2 world wars. It included the Great Depression. It included multiple financial crises, oil shocks, currency collapses, political upheavals, and countless moments when serious and intelligent people genuinely believed that the economic system as they knew it was coming to an end. And through all of it, through every catastrophe and every moment of despair, the market eventually recovered, eventually climbed to new heights, and eventually rewarded those who stayed the course. This is not a guarantee about the future. No one can promise you that what has happened in the past will happen again. But the reasoning behind why markets tend to grow over long periods of time is not just historical luck. It is rooted in something real. When you buy a share in a company, you are buying a small piece of a business that is trying to generate profit. Businesses, by their nature, are designed to grow. They reinvest their earnings. They develop new products. They expand into new markets. They find more efficient ways to operate. Over time, successful businesses become more valuable, and when the overall economy grows, which it does, on average, over long stretches of time, the total value of all these businesses tends to grow with it. An index fund that owns a piece of hundreds or thousands of businesses is participating in this growth. As the companies in the index earn more, as they expand and innovate and generate more value, the index rises, and the fund rises with it. Now, here is where something called compound growth enters the picture. And this concept is so important, so fundamental to why long-term investing in index funds is such a powerful strategy that it deserves its own careful explanation. Compound growth is the process by which your returns generate their own returns. In the first year, you earn growth on the money you initially invested. In the second year, you earn growth on that initial amount plus the growth from the first year. In the third year, you earn growth on everything that came before. And so on, year after year, decade after decade. At first, this process seems slow. The differences between years seem almost trivially small. But as time passes, the effect becomes extraordinary. The growth starts to accelerate in a way that is genuinely difficult for the human mind to intuitively grasp, because we are not naturally wired to think in exponential terms. Let us imagine someone who invests a fixed amount of money and earns a modest average annual return. After 10 years, the growth is noticeable but perhaps not stunning. After 20 years, it is impressive. After 30 years, the numbers are large enough to seem almost unbelievable compared to the original investment. After 40 years, for someone who started young enough, the results can be genuinely life-changing, not because of any special insight or clever strategy, but simply because of the passage of time and the mathematics of compounding. This is why the single most important variable in long-term investing is not the specific fund you choose, not the exact timing of your purchases, and not your ability to predict economic trends. It is time. The more time your money has to grow, the more powerful the compounding effect becomes. And the earlier you start, the more time you have. This is why young people who start investing small amounts early can end up with more money in retirement than older people who invested much larger amounts but started later. Index funds are perfectly designed to take advantage of this long-term compounding effect. Because they are low cost, more of your returns stay in your account instead of going to fees. Because they are diversified, you do not risk losing everything due to a single bad bet. And because they are designed to be held for long periods, not traded in and out frequently, they align perfectly with the patient, time-driven strategy that compounding requires. The enemy of compounding is impatience, and the enemy of patience in investing is fear. And the primary source of fear in investing is short-term market volatility. Those gut-wrenching drops that make the headlines and make you want to do something, anything to protect yourself. So let us talk about that. Let us talk about market volatility, what it actually is, and why index fund investors who understand it can use it to their advantage rather than being destroyed by it. Chapter 5. Market volatility and why it is your friend, not your enemy. The word volatility sounds alarming. It carries with it the sense of instability, of danger, of something unpredictable that could hurt you. When the news reports that the market was highly volatile today, it rarely sounds like good news. It sounds like a warning. But for the long-term index fund investor, volatility is not something to be feared. It is something to be understood, and once understood, it becomes something that can actually work in your favor. Let us start by defining what volatility actually is. Volatility simply refers to the degree to which the price of an asset moves up and down over a given period. A volatile market is one where prices change significantly and quickly. A low volatility market is one where prices are relatively stable. Stock markets are inherently volatile because they reflect the collective mood of millions of buyers and sellers reacting to an endless stream of new information, news events, economic reports, corporate announcements, and the general emotional state of the investing public. In the short term, this can look terrifying. Markets can drop significantly in a matter of days or weeks when fear takes hold. During major crises, markets have fallen dramatically, and those drops feel like they will never end when you are in the middle of them. The emotional impact of watching the value of your savings fall is real, powerful, and difficult to dismiss. But here is what the historical record consistently shows. Every single significant market decline in modern history has eventually been followed by a recovery and a return to new highs. Every one, without exception. The timing of those recoveries has varied. Sometimes the market bounced back quickly, within months. Sometimes recovery took years. But the direction, over sufficient time, was always eventually upward. What this means for the index fund investor who holds through the volatility, rather than selling in a panic, is that the drops become temporary, not permanent. The person who sold during the drop locked in their losses and missed the recovery. The person who held, and the person who continued to invest during the drop, was in a much better position when the recovery came. This is a concept called buying the dip, though in the context of index fund investing, it is not really about timing. It is simply about the natural effect of something called dollar cost averaging. If you invest a fixed amount of money regularly, regardless of what the market is doing, you will automatically buy more shares when prices are low and fewer shares when prices are high. Over time, this averages out your cost per share in a way that is mathematically advantageous. Think of it this way. If you love a particular food and it is normally priced at a certain level at the grocery store, and one day you walk in and find it on sale for significantly less, you do not leave the store in a panic. You buy more, you take advantage of the lower price. Investing in index funds during a market downturn is mathematically the same kind of opportunity. You are buying the same long-term growth engine at a lower price than you could yesterday. The problem is that market drops do not feel like sales. They feel like disasters. And this is where the psychological challenge of investing becomes central to the whole enterprise. Because knowing what to do and actually doing it in the moment when fear is running at full power are two very different things. This is another advantage of the index fund approach. Because the strategy is so simple, because it does not require you to make complex decisions at precisely the right moment, it is easier to stick to. You have a plan. Invest regularly, hold for the long term, do not react to short-term noise. That plan does not change based on what the market does today. It is built to run on autopilot, which means there are fewer opportunities for your emotions to override your rational judgment. The great investor Warren Buffett has famously said that the stock market is a device for transferring money from the impatient to the patient. This is not just a clever quote. It is a description of exactly what happens over and over again, in market cycle after market cycle. The impatient investor, the one who buys high during periods of excitement and sells low during periods of fear, ends up giving their gains to the patient investor, the one who held steady and let time do the work. Index fund investors are structurally positioned to be the patient ones. Because the strategy requires so little active decision-making, because there is no need to constantly evaluate and re-evaluate your holdings, you are less likely to interfere with your own investment and more likely to stay the course through the inevitable turbulence. This does not mean volatility is painless. It is not. Watching your portfolio drop significantly in value is genuinely uncomfortable, no matter how well you understand the theory behind why you should stay the course. But that discomfort is the price you pay for the long-term returns that the market has historically delivered. And compared to the alternative, the frantic, expensive, emotionally exhausting world of active trading that most people who try it eventually lose money doing, it is a very manageable price. Now that we have a foundation in what index funds are, how markets grow over time, and how to think about volatility, it is time to get more practical. In the next chapter, we are going to talk about the specific types of index funds available to you, what each of them does, and how to think about which ones might belong in your portfolio. Chapter 6. A tour through the world of index funds. The universe of index funds is larger and more varied than many people realize. When most people hear the phrase index fund, they immediately think of something that tracks the stock market. And while that is certainly the most common and most discussed type, it is far from the only one. Understanding the different categories of index funds gives you a much clearer picture of the full range of tools available to you as an investor. Let us walk through the major categories, one by one. The first and most well-known category is broad market stock index funds. These are funds that track a large diversified index of stocks. The S&P 500 is the most famous benchmark for this category. Funds that track this index hold shares in 500 large companies and are considered a core holding for many investors because of their combination of broad diversification and historical long-term performance. Other broad market funds track even wider indexes, sometimes including thousands of companies rather than 500, giving even broader exposure to the overall economy. The second category is international stock index funds. These funds track indexes of companies based outside of your home country. If you live in one country, your domestic stock market represents only a portion of the global economy. The world is full of growing businesses in Europe, Asia, Latin America, Africa, and beyond. International index funds give you access to that growth. Some funds focus on developed international markets, countries with established and stable economies. Others focus on what are called emerging markets, countries whose economies are growing rapidly and offer potentially higher returns but also higher risk. The third category is bond index funds. Bonds are a very different type of asset from stocks. When you buy a bond, you are essentially lending money to a government or a corporation, and in return, you receive regular interest payments over a set period, at the end of which you get your original money back. Bond index funds track indexes of many different bonds, giving you diversified exposure to the bond market. Bonds generally behave differently from stocks. They tend to be less volatile, and they often, though not always, move in the opposite direction from stocks during times of market stress. This makes them a useful counterbalance in a portfolio that also contains stocks. The fourth category is real estate index funds. These are funds that track indexes of what are called real estate investment trusts, or REITs. REITs are companies that own and operate income-generating real estate, things like office buildings, shopping centers, apartment complexes, warehouses, and data centers. Investing in a REIT index fund gives you exposure to the real estate market without having to buy or manage physical property. Real estate has historically provided returns that are somewhat different from both stocks and bonds, which can help diversify a portfolio further. The fifth category is sector and thematic index funds. Rather than tracking the broad market, these funds focus on specific sectors of the economy, such as technology, healthcare, energy, financials, or consumer goods. Thematic funds take this a step further, tracking indexes built around specific trends or ideas, such as clean energy, artificial intelligence, or demographic shifts. These funds are more concentrated than broad market funds, which means they offer less diversification and carry more risk. But for investors who have strong convictions about specific parts of the economy, they can be a way to express those views while still benefiting from the index fund structure. The sixth category is factor-based index funds, sometimes called smart beta funds. These are funds that track indexes constructed not just on market capitalization, but on specific financial characteristics called factors that research has suggested are associated with higher long-term returns. Common factors include value, which focuses on companies whose stock prices appear low relative to their underlying earnings or assets. Size, which focuses on smaller companies that have historically outperformed larger ones over long periods. Momentum, which focuses on companies whose stock prices have been rising and tend to continue rising in the short term. And quality, which focuses on companies with strong financial characteristics like low debt and consistent earnings. Factor-based investing sits somewhere between pure passive investing and active investing. The underlying logic is supported by academic research, but the funds still charge higher fees than plain market cap-weighted index funds, and the factors do not always perform as expected over all time periods. For most investors, especially those just starting out, the most useful categories are the first three: broad market stock index funds, international stock index funds, and bond index funds. Together, these three types of funds can form the backbone of a well-diversified, low-cost, long-term portfolio. But understanding the types of funds is only part of the picture. The next thing you need to understand is how these funds are packaged, because index funds come in two main formats, and each has its own characteristics, advantages, and practical considerations. Those two formats are mutual funds and exchange-traded funds, and the next chapter is going to explain both in clear, accessible language. Chapter 7. Mutual funds versus exchange-traded funds. When you decide you want to invest in an index fund, one of the first practical choices you will encounter is whether to invest in a mutual fund or an exchange-traded fund, which is usually referred to simply as an ETF. Both of these are vehicles that pool money from many investors and use that money to buy a collection of assets. Both can be structured as index funds, but they have some important differences in how they work, and understanding those differences will help you make a more informed choice. Let us start with mutual funds. A mutual fund is an investment vehicle that has been around for many decades. When you invest in a mutual fund, your money is pooled together with the money of thousands or even millions of other investors, and the whole pool is used to buy assets according to the fund's stated objective. If it is an index mutual fund, those assets will be whatever securities are included in the index it tracks. One distinctive feature of mutual funds is how they are priced and traded. Unlike stocks, which trade on exchanges throughout the day at constantly fluctuating prices, mutual funds are priced just once per day. At the end of the trading day, this price is called the net asset value, or NAV. When you submit an order to buy or sell a mutual fund, your transaction is processed at that day's NAV regardless of what time during the day you submitted the order. This once-per-day pricing means that mutual funds are not suited for short-term trading, but for long-term index fund investors, that is not a concern at all. Mutual funds often have minimum investment requirements. Some require you to invest a specific minimum amount before you can get started, though many fund providers have reduced or eliminated these minimums in recent years, particularly for their index fund options. Mutual funds also allow you to invest fractional amounts, meaning you can invest any dollar amount you choose, and the fund will give you the exact fractional share that corresponds to that amount. Now let us talk about exchange-traded funds. Exchange-traded funds, as the name suggests, trade on stock exchanges just like individual stocks. This means their prices fluctuate throughout the trading day, and you can buy or sell shares at any point during market hours at the current market price. ETFs were first introduced in the early 1990s and have grown enormously in popularity, particularly in the area of index investing. Because ETFs trade like stocks, you typically buy them in whole shares rather than fractional amounts, though many brokerages have introduced the ability to purchase fractional shares of ETFs, which reduces this limitation significantly. ETFs generally have no minimum investment beyond the price of a single share, which can be anywhere from a very small amount to a few $100s depending on the specific fund. ETFs are generally slightly more tax efficient than mutual funds in certain types of investment accounts. This has to do with the technical structure of how ETF shares are created and redeemed, which allows the fund to avoid realizing capital gains in ways that mutual funds sometimes cannot. For investors in taxable accounts, this efficiency can make a meaningful difference over time. So which one is better? The honest answer is that for most long-term index fund investors, the difference between a mutual fund and an ETF that tracks the same index is relatively small. Both will deliver very similar returns if they track the same underlying index and have similar fee structures. The choice often comes down to practical considerations: what your brokerage account supports, what the minimum investment requirements are, and whether you prefer the simplicity of automatic investing in set dollar amounts, which is easier with mutual funds, versus the ability to trade at any time during the day, which is a feature of ETFs that most long-term investors will rarely, if ever, need. The far more important variable than the mutual fund versus ETF distinction is the fee that the fund charges. That fee, measured as a percentage called the expense ratio, is the subject of the next chapter, and it is one of the most important things to understand if you want to maximize your long-term results. Chapter 8. The most important number you need to know. If you take only one concrete, actionable piece of knowledge from this entire audiobook, let it be this: the expense ratio of an investment fund is one of the most powerful determinants of your long-term results, and choosing low expense ratio funds over high expense ratio funds is one of the most impactful decisions you can make as an investor. The expense ratio is the annual fee that a fund charges to cover its operating costs. It is expressed as a percentage of your investment. If you have money invested in a fund with an expense ratio of 1%, you are paying 1% of your total investment to the fund each year. If the fund has an expense ratio of 0.1%, you are paying just 1/10 of that amount. On the surface, the difference between 1% and 0.1% might sound trivially small. What is a fraction of a percent after all? But the impact of this difference over time, compounded year after year, is staggering. Let us think through this carefully. If you invest a sum of money and it grows at a particular rate each year before fees, the amount that actually ends up in your pocket depends on how much of that growth is taken by fees. Every percentage point that goes to fees is a percentage point that is not compounding in your account. And because compounding works exponentially, the fees you pay early on do not just cost you that fee amount. They cost you all the future growth that fee amount would have generated if it had stayed invested. This is why financial educators often use the phrase fee drag to describe what high expense ratios do to a portfolio over time. They drag on the growth year after year, decade after decade, in a way that adds up to a genuinely enormous amount of money by the time you reach retirement. Index funds, because they require minimal active management, have historically offered much lower expense ratios than actively managed funds. The largest and most popular index funds from well-established providers now charge expense ratios that are extraordinarily low, sometimes below 0.1% per year. Some are even lower than that. Compare this to the average actively managed fund, which has historically charged fees many times higher than this. The difference in fees, compounded over a long investing career, can amount to a difference of potentially tens of thousands or even hundreds of thousands of dollars in the final value of your portfolio. The competition among major index fund providers over the past 2 decades has driven expense ratios to historic lows. This has been one of the most genuinely positive developments in personal finance in recent memory. Investors today have access to extraordinarily cheap, broadly diversified index funds that would have seemed almost unimaginably affordable compared to what was available to investors just 30 or 40 years ago. When evaluating any index fund, the expense ratio should be one of the first things you look at. Look for funds with expense ratios as low as possible. For broad market index funds, the lowest cost options are often well below 0.2% per year, and some are even lower. Any fund charging more than this for a simple broad market index tracking strategy deserves close scrutiny and a very good explanation. Beyond the expense ratio, there is another cost consideration that is particularly relevant for ETFs: the bid-ask spread. When you buy or sell an ETF on an exchange, you buy at the ask price and sell at the bid price, and there is a small gap between these two prices. For very popular, highly traded ETFs, this spread is extremely small and largely inconsequential. For less popular funds with lower trading volumes, the spread can be wider and adds a small additional cost each time you trade. For long-term index fund investors who trade infrequently, this is usually not a significant concern, but it is worth being aware of. There is also, in some cases, a transaction cost involved in buying and selling certain mutual funds. Some funds charge what is called a load, which is essentially a sales commission. Front-end loads are charged when you buy into the fund. Back-end loads are charged when you sell. No-load funds, which charge neither, are widely available and should be the clear preference for any investor who understands what these charges represent. All the index funds offered by the major low-cost fund providers are no-load funds. Understanding these costs and actively choosing to minimize them is not a passive act. It is one of the most active and impactful investment decisions you can make. Because you cannot control what the market returns, you cannot control which individual companies will thrive and which will struggle, but you can absolutely control what you pay for the fund that holds your investments. And what you pay in fees is, in a very literal and mathematical sense, subtracted directly from what you keep. Low fees are the index fund investor's secret weapon. They are quiet, they are invisible to the casual observer, and they compound just as powerfully as the returns themselves, working silently and consistently in your favor year after year. With this understanding of fees firmly in place, we can now turn to one of the most practical questions in all of personal investing. How do you actually put this all together into a real portfolio? How do you decide which index funds to buy, how much to put in each one, and how to manage that mix over time? That is what the next several chapters are going to explore. Chapter 9. Building your first index fund portfolio. The moment you decide to invest in index funds, you face a series of practical decisions. These decisions do not need to be overwhelming, and they do not require you to know everything about finance. But they do require you to think clearly about a few important things: what you are investing for, when you will need the money, and how much volatility you can genuinely tolerate without making emotionally driven mistakes. Let us work through these questions one by one. The first question is, what is the purpose of this money? This sounds simple, but the answer matters a great deal because it determines how long you have before you will need access to the funds, and that time horizon is the single most important factor in deciding how to allocate your investments. If you are investing for a retirement that is 30 or more years away, you have a very long time horizon. You can afford to take on more risk in the form of a higher allocation to stocks because you have decades for any short-term drops to recover before you need the money. If the market falls dramatically next year, you are not selling anything for 30 years. You will simply hold through the drop, continue investing, and benefit from the recovery. If you are investing for a goal that is 5 to 10 years away, such as buying a property, your time horizon is shorter and your allocation to stocks should probably be more conservative, with a larger portion in bonds or other more stable assets. A significant market drop right before you need the money could seriously impact your plans. If you are investing for a goal that is less than 5 years away, putting that money in the stock market at all carries meaningful risk, and a more conservative approach is appropriate. This relationship between time horizon and risk tolerance is fundamental to portfolio construction. The longer your time horizon, the more you can afford to invest in higher risk, higher potential return assets like stocks. The shorter your time horizon, the more you want to protect what you have with lower risk assets like bonds. The second question is, how will you actually feel when your portfolio drops significantly? This is not the same as asking how much risk you are theoretically comfortable with. Everyone says they are comfortable with risk when markets are rising. The real test comes when markets fall, and they will fall. Every investor experiences significant drops at some point in their journey. Thinking honestly about your emotional response to market drops is not a sign of weakness. It is a sign of self-awareness. If you know that you will struggle to sleep at night if your portfolio drops by 30% in value, that knowledge should influence how you build your portfolio. An allocation to bonds and other more stable assets can reduce the magnitude of those drops, even if it also reduces the potential for long-term gains. A portfolio you can actually hold through rough times is better than a theoretically optimal portfolio that you abandon in a panic when things get difficult. Once you have thought through your time horizon and your emotional relationship with risk, you can begin to think about the actual allocation between stocks and bonds. This allocation is often expressed as a ratio, 60% stocks and 40% bonds, or 70% stocks and 30% bonds, or 80% stocks and 20% bonds. For very young investors with decades ahead of them, allocations of 90 or even 100% stocks are not uncommon. For investors closer to retirement, a more balanced split provides more stability. There is an old rule of thumb that says you should subtract your age from 100 to get your stock allocation. So a 30-year-old would hold 70% stocks and 30% bonds. This is a simplistic rule and does not account for individual circumstances, but it captures the basic principle. As you age and your time horizon shortens, you gradually shift from higher risk growth assets toward more stable income-producing assets. Within the stock portion of your portfolio, you then have the choice of how to allocate between domestic stocks and international stocks. Many investors choose to hold a significant portion of their stock allocation in their home country's market because they are most familiar with it and because it is most relevant to their financial life. But international diversification adds an additional layer of protection because the performance of different countries' stock markets is not perfectly correlated. When one country's market is struggling, others may be doing well, and owning both gives your portfolio a smoother ride. A simple starting point for many investors is to allocate roughly half of their stock holdings to their home market and the other half to international markets, though the appropriate split depends on the size and development of your home market relative to the global economy. So, to bring this together into a concrete example, a young investor with a long time horizon and high risk tolerance might start with a portfolio that is something like 80 or 90% in a broad domestic stock index fund and 10 to 20% in an international stock index fund. As they age, they might gradually introduce a bond index fund and increase its allocation over time. This is the essence of building an index fund portfolio. It is not complicated. It does not require deep financial expertise. It requires you to think clearly about your goals, your time horizon, and your emotional relationship with risk, and then to translate those factors into a simple, low-cost, diversified mix of index funds. But there is one more critical element to this process that we have not yet fully addressed, and it is perhaps the most underrated factor in the success of any long-term investment strategy. That element is consistency. And the next chapter is about why showing up regularly, year after year, through the good times and the bad, is ultimately more powerful than any investment selection you make. Chapter 10. The Power of Consistency and Dollar-Cost Averaging. There is a concept in investing that sounds almost too simple to be profound, and yet it is, in practice, one of the most powerful forces available to any ordinary investor. That concept is consistency, and its practical expression is a strategy called dollar-cost averaging. Dollar-cost averaging is nothing more than investing a fixed amount of money at regular intervals, regardless of what the market is doing. You decide, at the beginning, on an amount you can comfortably invest each month or each quarter, and then you invest that amount, automatically and without exception, whether the market is at an all-time high, in the middle of a significant drop, or anywhere in between. This seems almost boring in its simplicity, but let us think carefully about what this strategy actually does for you. When you invest a fixed dollar amount regularly, the number of shares you purchase varies based on the current price of the fund. When prices are high, your fixed dollar amount buys fewer shares. When prices are low, your fixed dollar amount buys more shares. Over time, this natural pattern means that you automatically accumulate more shares when they are cheap and fewer shares when they are expensive. The result is that your average cost per share over time tends to be lower than the average price during the period you were investing. This is the mathematical advantage of dollar cost averaging. But the psychological advantage is just as important, if not more so. Because you have committed to investing a fixed amount on a regular schedule, regardless of market conditions, you do not have to make a decision every month about whether this is a good time to invest. You have taken that decision off the table. The market has been falling for 3 months. Your automatic investment still goes in. The financial news is full of doom. Your automatic investment still goes in. There is political uncertainty and everyone seems afraid. Your automatic investment still goes in. This automation is a genuine protective mechanism against your own emotions. Because you have committed to the system in advance, during a calm and rational moment, the system keeps running even when the emotional environment around you is suggesting that you should stop and wait. And stopping and waiting, as the historical record makes clear, is usually exactly the wrong thing to do. Research has consistently shown that the average investor significantly underperforms the average fund they invest in. The reason for this counterintuitive finding is timing. Individual investors tend to pour money into funds after strong recent performance, when prices are high, and to pull money out after poor recent performance when prices are low. This buy high, sell low pattern, driven by emotion and recency bias, destroys returns. Dollar cost averaging is a direct antidote to this pattern because it removes the need to make timing decisions at all. The way to set this strategy up in practice is through automation. Most investment accounts and brokerage platforms allow you to set up automatic recurring investments. You link your bank account, specify a fixed amount, and choose a frequency. Monthly is the most common, and the system does the rest. The money moves from your bank account to your investment account automatically, buys more shares of your chosen index funds automatically, and you do not have to think about it further unless you choose to. This automation also addresses another powerful obstacle to successful long-term investing: inertia. We are all busy. Life is full of demands on our time and attention. When investing requires a conscious, active decision every month, it is too easy to put it off, to tell yourself you will get to it next week, and then to let months or years pass without investing at all. Automation removes this friction entirely. Once it is set up, it runs on its own, and your investment habit becomes as automatic and effortless as a bill payment. The compounding power of consistent investing over time is genuinely remarkable. Every fixed amount you invest today is the seed of a much larger amount in the future, thanks to the compounding returns we discussed in an earlier chapter. Every month you delay is a month of compounding that you lose and cannot get back. And every month you invest consistently is a month of building toward a future financial position that will thank you. Consistency does not require perfection. There will be months when money is tight and you need to reduce your contribution. There will be unexpected expenses that disrupt your plan. This is life, and life is not linear. The goal is not perfect consistency but sustained, persistent commitment to the practice over many years. Missing a month is not a disaster. Abandoning the strategy entirely because of a difficult stretch is. The investors who succeed with index funds are not, by and large, people with extraordinary financial intelligence or privileged access to information. They are people who set up a sensible, low-cost system and then stuck to it through good times and bad, through years when everything felt great and years when everything felt scary, through bull markets and bear markets and everything in between. Now that we have explored the strategy of consistent investing, there is another dimension of the index fund investor's world that deserves careful attention. That dimension is taxation. Because how your investments are taxed and how you can legally minimize that tax burden has a very significant impact on how much of your investment growth you actually get to keep. Chapter 11: Taxes, Tax-Advantaged Accounts, and the Index Fund Investor. Taxes are one of the few certainties in life, and they apply to investment returns just as they apply to income. But the good news is that the rules around investment taxation include significant opportunities for legally reducing what you owe, and index fund investors are particularly well positioned to take advantage of these opportunities. Let us start with the basics. When you earn a return on your investments, that return can come in two main forms. The first is income, which includes dividends paid by companies in your fund and interest paid by bonds. The second is capital gains, which is the profit you make when you sell an investment for more than you paid for it. These two types of returns are typically taxed differently, and the specific rules vary by country. In many places, investment income is taxed at ordinary income tax rates, while long-term capital gains, meaning gains on investments you have held for longer than 1 year, are taxed at lower preferential rates. This is one reason why the index fund approach, with its emphasis on buying and holding rather than frequent trading, is tax efficient. By holding your investments for long periods, you allow your gains to qualify for preferential long-term tax treatment rather than being taxed at the higher short-term rate. But perhaps the most powerful tool available to most investors for reducing their tax burden is the tax-advantaged retirement account. Different countries have their own specific versions of these accounts with different rules and limits, but the fundamental concept is consistent. The government offers you a tax benefit in exchange for committing your money to a retirement savings account with restrictions on when and how you can access it. There are generally two main types of tax advantage offered by these accounts. The first type is a tax deduction on contributions. When you contribute money to this type of account, that contribution reduces your taxable income for the year, which means you pay less tax now. The investment then grows within the account without being taxed each year. When you eventually withdraw the money in retirement, you pay income tax on the withdrawals. This type of account is sometimes called a traditional account, and it is valuable because it allows your entire pre-tax contribution to grow and compound, rather than the after-tax amount. The second type is a tax exemption on withdrawals. You contribute money to this type of account with after-tax dollars, meaning you do not get a deduction now. But the investment grows tax-free within the account, and when you withdraw the money in retirement, you pay no tax at all on the withdrawals, including all the growth. This type of account is often called a Roth account in countries that offer it, and it can be extraordinarily valuable for young people who are currently in a lower tax bracket than they expect to be in retirement, because they pay tax now at a lower rate and then enjoy completely tax-free growth for decades. Maximizing your contributions to these tax-advantaged accounts before investing in regular taxable accounts is one of the clearest and most universally agreed-upon pieces of financial advice available. The tax savings over a long investing career, whether in the form of deductions now or tax-free growth later, can amount to a very large sum of money, effectively giving you a guaranteed return that no market investment can match. If your employer offers a retirement plan with any kind of matching contribution, meaning they will add money to your account based on your contributions, that matching money is essentially free money, and capturing every dollar of it should be an absolute priority before any other form of investing. Within these tax-advantaged accounts, index funds are an ideal investment. Their low costs mean that more of your money stays in your account. Their tax efficiency means that even in taxable accounts, they generate fewer taxable events than actively managed funds, because they trade less frequently and therefore realize capital gains less often. And their simplicity means that you can set up an automatic investment plan, fill your account with a few well-chosen index funds, and let it run year after year with minimal attention. One additional tax consideration worth understanding is tax loss harvesting. This is a strategy used in taxable accounts where, if one of your investments has dropped in value, you sell it to realize the loss on paper, which can offset capital gains you have realized elsewhere and reduce your tax bill for the year. You then immediately reinvest the proceeds in a very similar but not identical fund so that you maintain your market exposure. Index fund investors in taxable accounts may encounter opportunities to harvest losses during market downturns, turning a short-term decline into a tax benefit without changing their long-term investment position. Taxes are a complex topic, and the specific rules that apply to you will depend on your country of residence, your specific financial situation, and the accounts you have access to. Consulting a tax professional who understands investment accounts is always a worthwhile investment of time and money. But the fundamental principle is clear. Taking full advantage of tax-advantaged accounts, holding investments for long periods, and choosing low-cost index funds are a powerful combination for legally minimizing the tax burden on your investment returns. We have now covered the foundational concepts of index fund investing: what these funds are, how markets grow, how to manage volatility, how to build a simple portfolio, the power of consistent investing, and how to think about taxes. In the next chapter, we are going to address one of the most common pitfalls that investors fall into, even investors who understand all of the above. That pitfall is called performance chasing, and understanding it could save you a great deal of money and frustration. Chapter 12. The Trap of Performance Chasing. Human beings are pattern-seeking animals. We look for patterns everywhere, in clouds, in history, in data, and especially in investment returns. And one of the most intuitive patterns to notice is that a fund or asset that has performed very well recently must be a good investment. It has gone up. It has delivered great returns. Surely it will continue to do so. This intuition is understandable. And it is, in the context of investing, often deeply wrong. Performance chasing is the practice of investing in whatever has recently done well, on the assumption that recent performance predicts future performance. It is one of the most widespread and damaging behaviors in all of investing, and it traps both professional and amateur investors with remarkable consistency. Here is what actually happens, again and again, throughout the history of markets. A particular sector, asset class, geographic region, or investment strategy delivers exceptional returns for a stretch of time. This exceptional performance generates media coverage, generates enthusiasm, and generates a flood of new investor money pouring in. That new money drives prices even higher, which generates more enthusiasm and more money, which drives prices higher still. The cycle continues until prices become detached from any reasonable fundamental value, at which point they eventually correct, often sharply and painfully, precisely at the moment when the most investors are exposed to them because they rushed in at the top. Meanwhile, the assets and strategies that have been underperforming for the same stretch of time are unpopular, widely ignored, or even actively dismissed. And those, very often, are exactly the assets that go on to deliver the next period of strong performance because they are priced more modestly and the cycle eventually turns. This pattern is not universal, and it does not happen on a predictable schedule. But it recurs with enough regularity that the evidence against performance chasing across decades of data from markets around the world is overwhelming. The financial industry unfortunately does little to discourage performance chasing, and in many cases actively encourages it. Advertisements for investment funds frequently feature recent performance figures prominently, inviting potential investors to imagine that those returns will continue into the future. Fine print, usually in very small text at the bottom, reminds the reader that past performance does not guarantee future results. This disclaimer is legally required in many places because it is absolutely true, but the advertising is designed to make you feel the opposite. For index fund investors, performance chasing takes a specific form. It might mean switching from a broad market index fund to a specific sector fund that has recently outperformed. It might mean selling your international index fund after a period of poor performance relative to your domestic fund and concentrating everything in the domestic market. It might mean jumping from one index fund provider to another based on which had slightly better returns last year. All of these are variations of the same error, reacting to recent performance in a way that overrides the long-term strategy you set up when you were thinking clearly and rationally. The antidote to performance chasing is what is called an investment policy statement. A simple document you write for yourself that clearly describes your investment strategy, your allocations, the funds you have chosen, the reasons for those choices, and the conditions under which you would make changes. This document is written during a calm moment when you are thinking clearly and not reacting to market events. And it is referenced during volatile moments when your emotions are pushing you toward impulsive decisions. Having this document does not eliminate the temptation to make changes, but it forces you to confront what you actually agreed to when you were not being driven by fear or greed. The clearest test of whether a potential change to your portfolio is sound is this: would you make this change if the market had been flat for the past year? If the answer is no, then you are reacting to performance, not making a rational decision. Performance should not be the primary driver of changes to a well-constructed index fund portfolio. This does not mean your portfolio should never change. There are legitimate reasons to rebalance your portfolio, to adjust your allocation as you age, or to switch funds if a meaningful and sustained difference in costs justifies it. But these changes should be based on your goals and your personal circumstances, not on what the market has done recently. Closely related to performance chasing is another common mistake: confusing intelligence with a bull market. When markets have been rising for an extended period, everyone who has been invested looks like a genius. Risky strategies look brilliant. Highly leveraged bets look like they pay off every time. And the investors who have been most aggressive look like the smartest people in the room. This environment is exactly when the danger of complacency is highest, because it leads people to take on more risk than their actual situation warrants, just as the cycle is approaching its peak. The humble, boring, consistent index fund investor does not look like a genius during these periods. They are not getting rich the fastest. They are not the subject of admiring articles about their spectacular returns. They are just steadily accumulating shares, month after month, at whatever the current price happens to be. And when the inevitable correction comes, they find that they are in a much better position than the performance chasers because they did not load up on overpriced assets at the peak. Index fund investing, at its core, is a rejection of the performance-chasing mentality. It says, "I do not know which specific asset will perform best next year. No one reliably does. So I am going to own everything broadly, cost as little as possible, and let time deliver the results that markets have historically delivered." That is not a glamorous strategy. But glamour, in investing, is often expensive. Chapter 13. The role of rebalancing in your portfolio. We have talked about building a portfolio with a specific allocation between stocks and bonds, and between domestic and international stocks. But here is something that happens automatically over time. That allocation drifts. If stocks have a particularly good year and bonds have a flat or negative year, the stock portion of your portfolio will grow to represent a larger percentage of the whole. If stocks then have a terrible year, the damage will be larger than it would have been if you had maintained your original allocation. This drift away from your intended allocation is natural and inevitable, and managing it is the reason investors rebalance. Rebalancing is the process of periodically returning your portfolio to its original intended allocation by selling assets that have grown to represent more than their target percentage and buying assets that have fallen below their target percentage. For example, if you originally intended to hold 60% stocks and 40% bonds, and strong stock performance has pushed your actual allocation to 75% stocks and 25% bonds, rebalancing means selling some stocks and buying more bonds to restore the 60-40 balance. This process has several benefits. First, it maintains your intended risk level. If your stock allocation has drifted significantly higher than intended, you are carrying more risk than you originally decided was appropriate. Rebalancing corrects this. Second, rebalancing forces you, in a disciplined way, to sell high and buy low. When stocks have been performing well and bonds have been underperforming, rebalancing has you selling some of the stock that has grown expensive and buying more of the bond that has become cheaper. This is the opposite of performance chasing, and it is the kind of counterintuitive but mathematically sound behavior that tends to serve long-term investors well. How often should you rebalance? There are two main approaches. The first is calendar-based rebalancing. You choose a specific date, once per year or twice per year, and you rebalance your portfolio on that date regardless of how far it has drifted. The second is threshold-based rebalancing. You set a trigger, such as any allocation drifting more than 5 percentage points from its target, and you rebalance whenever that threshold is crossed. Both approaches work. Calendar-based rebalancing is simpler and requires less monitoring. Threshold-based rebalancing may be slightly more efficient in some market environments. For most index fund investors, an annual review and rebalance is perfectly adequate and strikes the right balance between staying on target and avoiding unnecessary transactions. In tax-advantaged accounts, rebalancing is straightforward because selling assets does not trigger a tax liability. In taxable accounts, rebalancing by selling assets that have gained in value can trigger capital gains taxes, so it requires a bit more care. One approach that minimizes this tax impact is to rebalance primarily through your new contributions. When you add money to your portfolio, you direct it toward the asset classes that are currently below their target allocation, gradually restoring the balance without requiring you to sell anything. This approach works best when you are still in the accumulation phase of your investing life and are regularly adding new money. Rebalancing is one of the few active decisions that index fund investors need to make, and even this decision can be largely automated or reduced to a once-a-year review. Some funds, called target date funds, even rebalance automatically, which brings us to a topic worth exploring: the all-in-one solutions that exist for investors who want the simplest possible approach. Chapter 14: Target Date Funds and All-in-One Solutions. For investors who want to reduce the number of decisions they need to make to an absolute minimum, there is a category of index fund that takes care of almost everything at once. These are called target date funds, and they represent the logical endpoint of the simplicity-first philosophy that underlies all index fund investing. A target date fund is a single fund that holds a mix of stocks and bonds, designed to automatically adjust that mix over time as you approach a specific target retirement date. The fund's name typically includes a year. A fund with a target date of a particular year in the future is designed for investors who plan to retire around that year. In the early years, when retirement is decades away, the fund holds a high proportion of stocks and a low proportion of bonds, reflecting the higher risk tolerance appropriate for a long time horizon. As the years pass and the target date approaches, the fund automatically shifts its allocation, gradually increasing the bond proportion and reducing the stock proportion. This gradual shift toward more conservative investments is called the glide path, and it happens automatically without any action required from the investor. For a beginner investor who wants to start investing with the smallest possible number of decisions, a target date fund that corresponds to their expected retirement year represents an almost complete solution. There is one fund to buy. You contribute to it regularly. It diversifies across stocks and bonds, rebalances automatically, and adjusts its risk level as you age. You never have to decide on allocations, rebalance manually, or make any ongoing decisions about your portfolio. The fees on target date funds from major low-cost providers are generally reasonable, though typically slightly higher than what you would pay for individual index funds, because of the additional management involved in maintaining the glide path. Whether this small additional cost is worth the additional simplicity is a personal calculation that depends on how much you value the hands-off nature of the approach. For investors who want the simplicity of a one-fund solution without the restrictions of a target date structure, there are also balanced index funds and all-in-one funds that hold a fixed allocation of stocks and bonds, such as 60% stocks and 40% bonds, and maintain that allocation through automatic rebalancing. These funds do not adjust their allocation over time the way target date funds do, but they provide diversification and automatic rebalancing within a single, simple package. One increasingly popular approach is sometimes called the three-fund portfolio. This consists of three simple index funds: one that tracks your domestic stock market, one that tracks international stock markets, and one that tracks the bond market. Together, these three funds provide broad diversification across essentially the entire global investment universe. The exact allocation between these three funds is chosen based on your individual circumstances, and you rebalance periodically to maintain your target allocation. This approach is simple enough for virtually any investor to manage, yet sophisticated enough to provide very good long-term results. Whether you go with a single target date fund, an all-in-one balanced fund, a three-fund portfolio, or some other simple combination of index funds, the common thread is the same: simplicity, diversification, low cost, and patience. These four principles, applied consistently over a long period, form the complete recipe for successful index fund investing. We have now covered the core mechanics and strategy of index fund investing in considerable depth. But there are important psychological and behavioral aspects of this journey that deserve their own careful attention. Because the greatest enemy of the index fund investor is not the market itself, it is often the investor's own mind. Chapter 15: The psychology of index fund investing. Everything we have discussed so far, the mechanics of index funds, the mathematics of compounding, the logic of diversification, the importance of low fees, and the strategy of consistent investing, all of it is relatively straightforward to understand intellectually. The challenge is not understanding the strategy. The challenge is consistently executing it, year after year, when the world around you is sending powerful emotional signals that tell you to do something different. Let us talk about some of the most common and most dangerous psychological traps that investors encounter, and how the index fund approach helps neutralize each of them. The first trap is overconfidence. Research in behavioral finance has consistently shown that most people rate their own intelligence, judgment, and skill above average in almost every domain. This overconfidence extends to investing. Most active investors believe that they have insights or abilities that will allow them to outperform the market. A small number do, for a period of time. A very small number do consistently over very long periods. The evidence suggests that most people who believe they have an edge do not. And the cost of acting on this mistaken belief through higher transaction costs, tax inefficiency, and suboptimal timing is real and measurable. Index fund investing is, at its root, an act of intellectual humility. It says, I recognize that consistently beating the market is very difficult, that most people who try it fail, and that my time and energy are better spent on other things than trying to achieve what the data suggests is largely impossible. This is not defeatism, it is rational realism, and it is ultimately a much more powerful approach than tilting at windmills. The second trap is loss aversion. Research has shown that the pain of losing a given amount of money is roughly twice as powerful psychologically as the pleasure of gaining the same amount. This asymmetry is deeply embedded in human psychology, and it has profound consequences for investing. It means that a market drop of 20% feels roughly twice as bad as a 20% gain feels good. And it means that investors are strongly inclined to take actions to avoid losses, even when those actions are counterproductive to their long-term goals. During a significant market drop, loss aversion whispers, sell now before it gets worse. And when investors listen to that whisper and sell, they lock in their losses and position themselves to miss the recovery. The historical pattern is clear. The investors who sold during major market drops, the ones who listened to their loss aversion, typically did worse over the following years than those who held. Understanding that loss aversion is a hardwired psychological response, not a rational signal from your investing judgment, can help you recognize when it is speaking and choose not to act on it. Building a portfolio that you can genuinely hold through major drops, which may mean accepting a more conservative allocation than your theoretical risk tolerance suggests, also helps. Because a portfolio that causes you to abandon the strategy is worse than a slightly more conservative portfolio that you actually stick with. The third trap is the illusion of control. Human beings are deeply uncomfortable with uncertainty, and we will go to great lengths to create the feeling of control, even when actual control is not available. In investing, this manifests as excessive monitoring of portfolio values, constant reading of financial news, and a tendency to make frequent adjustments in response to market movements. Each of these activities creates the feeling that you are doing something, that you are managing and controlling your investment. But most of the time, this activity reduces returns rather than improving them, through transaction costs, tax drag, and poor timing. The index fund approach encourages a different relationship with your portfolio. Rather than monitoring it constantly and responding to every fluctuation, you check it periodically, perhaps quarterly or annually, make any necessary rebalancing adjustments, and then leave it alone. The less you look, in many cases, the better. There is research showing that investors who check their portfolios less frequently make fewer reactive decisions and end up with better outcomes than those who monitor constantly. The fourth trap is social comparison. We live in an age where information about how other people are doing financially is more visible than ever. Stories of spectacular investment gains circulate widely, whether it is someone who made extraordinary returns on a speculative investment or someone who got rich on a particular stock. When these stories circulate, they make it easy to feel like you are missing out, like your boring, steady index fund approach is leaving money on the table. This feeling is almost always misleading. The stories that get told and shared are the extraordinary successes, the far more common stories of people who took large speculative risks and lost, of people who chased performance and were burned, of people who tried clever strategies and underperformed the simple index do not circulate as widely. They do not make for exciting social media content, but they represent the far more typical outcome of departing from a simple, evidence-based strategy. The comparison that matters is not how you are doing relative to the person who got lucky on a speculative trade. It is how you are doing relative to where you need to be to meet your long-term goals. And a steady, consistent, low-cost index fund approach, executed patiently over many years, is one of the most reliable ways to meet those goals that the history of investing has ever produced. The fifth and perhaps most pervasive trap is simply the constant noise of financial media. Headlines are designed to get your attention, and attention is captured by urgency, by fear, and by the dramatic. Every financial crisis is portrayed as potentially catastrophic. Every market rally is described with breathless excitement. Every economic development is analyzed from the perspective of what it means for your portfolio right now. Most of this noise is irrelevant to the long-term index fund investor. If your investment horizon is 20 or 30 years, what the market does this week or this month or even this year is a very small piece of a very large picture. The signal that matters is the long-term trend, and that trend has historically been upward. Staying focused on the long view and deliberately tuning out the short-term noise is one of the most productive habits an index fund investor can develop. Chapter 16. Common Questions and Misconceptions about Index Funds. Over the years, as index fund investing has grown from a fringe idea to a mainstream approach, a number of questions and misconceptions have emerged. Some of these are genuine intellectual concerns. Others are arguments made by those who benefit financially from active management. And some are simply misunderstandings born from confusion about how these funds actually work. This chapter addresses the most common of them. The first question is one that many people raise when they first encounter the index fund philosophy. If everyone invests in index funds, will markets become inefficient? This is a genuinely interesting theoretical concern. The argument goes something like this. If all investors simply buy index funds without doing any analysis of individual companies, then no one is analyzing companies to determine their fair value, and prices will become divorced from reality. Markets rely on active investors doing research and making judgment calls to set prices correctly. If passive investors crowd out active investors, the mechanism by which prices are kept accurate could break down. This is a coherent theoretical argument, but the evidence suggests we are nowhere near the point where it becomes a practical concern. Active management still accounts for a very large proportion of total investment activity in global markets. There are many professional investors, hedge funds, institutional traders, and proprietary trading firms whose entire business is finding and exploiting pricing inefficiencies. As long as there is money to be made from doing this, there will be people doing it. And in fact, some researchers have argued that even if passive investing grows substantially further, the remaining active investors would become even more efficient at price discovery because the inefficient active managers would have been eliminated, leaving only the best. The second common misconception is that index funds are only appropriate for long-term investors and are not suitable for people who are closer to retirement. This is wrong for a specific reason. Index funds themselves are not inherently long-term or short-term instruments. They are simply a vehicle for accessing a particular market or asset class. A bond index fund can be an appropriate holding for an investor of any age, including someone who is in or near retirement. A stock index fund might be less appropriate for money that will be needed within a few years. But the index fund structure itself, the low-cost, diversified, passively managed approach, is beneficial regardless of the investor's age. What changes with age is the allocation between different types of index funds, not whether index funds should be used at all. The third misconception is that actively managed funds are better during volatile or uncertain markets, that a skilled manager can navigate downturns better than a passive index fund. The evidence does not support this view. While there are periods when certain actively managed funds have outperformed during market downturns, the broad data shows that most actively managed funds, on average, do not consistently protect investors better during bear markets than index funds. And the fees charged by active managers mean that even if they match index fund performance on the downside, they need to significantly outperform on the upside just to deliver equivalent net returns. The track record, measured across many funds and many market cycles, does not generally support the claim that active management provides reliable downside protection. The fourth question is whether it matters which index fund provider you choose, or whether all index funds tracking the same index are essentially identical. The answer is that funds tracking the same index are very similar but not quite identical. The two main differences are the expense ratio and the tracking error. The expense ratio we have already discussed at length. The tracking error is the degree to which a fund's actual performance differs from the performance of the index it is supposed to track. A fund with high tracking error is either more expensive to run, holds fewer of the index securities than the full list, or has other inefficiencies that cause it to diverge from the index. The best funds have both very low expense ratios and very low tracking errors. When comparing funds that track the same index, the expense ratio is typically the most important differentiating factor. Minor differences in tracking error are usually far less impactful than the difference in annual fees. Choose the lowest cost option from a reputable provider with a strong track record of accurately replicating its target index. The fifth concern is one that is more emotional than analytical. Index funds are boring. Is it really a good investment strategy to just accept average returns? This concern misunderstands what index funds actually deliver. They do not deliver average returns. They deliver market returns, minus a very small fee. The distinction matters because, as we have established, most actively managed funds do not actually deliver market returns after fees. They deliver below-market returns. When you own a broad market index fund, you are not settling for average. You are capturing the full return of the market, which, it turns out, is better than what most alternatives deliver net of costs. And yes, it is boring. The strategy requires almost no active engagement, generates very little excitement, and produces no dramatic stories to tell at parties. But boring and effective are not contradictions in investing. In fact, in the specific context of long-term index fund investing, boring is a feature, not a bug. The boredom means you are not churning your portfolio, not racking up transaction costs, not making emotionally driven decisions, and not letting your ego lead you into overconfident bets. Boring, in this context, is the path to wealth. Chapter 17. Index Fund, Investing Around the World. One of the beautiful things about the index fund philosophy is that it transcends borders. The fundamental logic, own the market broadly, minimize costs, invest consistently, and hold for the long term, applies regardless of where in the world you live or invest. That said, the specific implementation of an index fund strategy does vary by country. The availability of specific funds, the tax rules governing investment accounts, the structure of retirement savings systems, and the regulatory environment all differ significantly from place to place. Understanding how these factors apply in your specific context is important. In many developed economies, the index fund revolution has produced a wide array of low-cost options from major providers. Investors in these markets typically have access to broad market funds covering their domestic market, international markets, and bond markets, all at very low cost through competitive providers. In some markets, particularly in emerging economies, the range of low-cost index funds may be more limited. Not every market has the same depth and variety of passive investment products. In these cases, investors may need to work with what is available, which might mean accepting slightly higher costs or slightly less diversification than is achievable in markets with more developed investment products. The global stock market, when considered as a whole, represents an enormous and diversifying range of economies, industries, and opportunities. Some investors choose to capture this global diversification through a single global index fund that tracks an index of thousands of companies across dozens of countries all at once. This ultra-broad approach represents the ultimate in diversification and simplicity. Others prefer to hold separate domestic and international funds, which gives them more control over the specific proportion of domestic versus international exposure in their portfolio. Both approaches are valid, and the right choice depends on your preferences, your home country's market size and characteristics, and the specific funds available to you. One consideration that is particularly relevant for investors in smaller or less developed markets is currency risk. When you invest in funds that hold assets denominated in foreign currencies, your returns are affected not just by the performance of the underlying assets, but also by changes in exchange rates between your home currency and the currencies of the assets. This currency risk is a form of additional volatility that goes away if you hold only domestic assets. But domestic-only investing sacrifices the diversification benefits of international exposure. Most long-term investors accept currency risk as part of a globally diversified portfolio, recognizing that over long periods, currency fluctuations tend to average out and do not fundamentally change the case for international diversification. The principle of investing in low-cost index funds also applies to bond markets in different countries. Government bonds, corporate bonds, and inflation-linked bonds in different markets offer different characteristics in terms of risk, return, and inflation protection. Understanding the bond market in your specific country and region is important for building the fixed income portion of your portfolio appropriately. Regardless of where you live, the core principles remain constant. Own broadly through diversified index funds. Minimize costs relentlessly. Use tax-advantaged accounts to the fullest extent available. Invest consistently through automatic contributions. Rebalance periodically. And above all, hold for the long term, staying patient through the inevitable periods of short-term volatility. These principles are not proprietary to any one country's financial system. They are grounded in the universal mathematics of compounding, the historical tendency of market economies to grow over time, and the simple reality that costs compound just as returns do, working against you every year. Wherever you are in the world, these truths apply. Chapter 18. The Index Fund Investor at Different Life Stages. The optimal approach to index fund investing is not the same at every stage of life. The strategy is consistent at its core, but the specific implementation, particularly the allocation between different types of assets, should evolve as your life circumstances change. Let us walk through the major life stages and explore how the index fund approach looks at each. When you are young and just beginning your working life, typically in your 20s or early 30s, the most powerful asset you have as an investor is time. Decades of compounding ahead of you means that even small amounts invested now can grow into very significant sums by the time you reach retirement age. At this stage, time horizon is long, and the ability to weather short-term volatility without needing to sell is high. This argues for a high allocation to stocks, taking on the additional short-term volatility in exchange for the higher long-term returns that equities have historically delivered. The practical implication for a young investor is to fill tax-advantaged retirement accounts first, choose a low-cost broad market stock index fund, and set up an automatic monthly contribution. Then, do not look at it very often. The specific amounts are less critical than the habit. Starting with a small amount and increasing it over time as income grows is a perfectly sound approach. The earlier you start, the more powerful the compounding effect. In your 30s and 40s, you are typically earning more. Your financial responsibilities may be significant, including perhaps a mortgage, children, and the costs associated with building a life, but your investment horizon is still very long. The stock-heavy allocation of your younger years likely remains appropriate, though you may begin to introduce a modest bond allocation to slightly smooth the ride. This is also the stage when it becomes important to make sure your financial foundation is solid. Adequate emergency savings, appropriate insurance coverage, and a clear understanding of your overall financial picture. Many people in this stage of life are also dealing with the question of competing financial priorities. Should you invest more aggressively in your retirement accounts, or pay down your mortgage faster, or save for your children's education? These are genuine trade-offs without a single correct answer. The right balance depends on factors like your interest rates, your tax situation, your risk tolerance, and your personal values. But in general, taking advantage of employer retirement account matching, minimizing high-interest debt, and maintaining consistent retirement contributions are priorities that hold across most situations. In your 50s, retirement begins to feel less abstract and more imminent. This is the time when many investors begin to meaningfully shift their portfolio toward a more conservative allocation, gradually increasing their bond holding and reducing their stock exposure. The goal is to reduce the risk of a catastrophic market drop occurring right at the moment you are about to retire, which would significantly damage your starting financial position in retirement. This shift should be gradual, not sudden, and should still leave a meaningful portion in stocks because, even in retirement, your investment horizon may extend for 20 or 30 more years, during which you still need growth to outpace inflation. At retirement, the investment equation shifts fundamentally. You are now no longer adding money to the portfolio. Instead, you are beginning to draw money out. This changes how you think about volatility in a significant way. When you were in the accumulation phase, a market drop was an opportunity to buy more at lower prices. When you are in the withdrawal phase, a market drop means you are selling shares at lower prices to fund your living expenses, which is a much more problematic situation. Managing this risk in retirement involves maintaining a thoughtful allocation that balances growth to keep pace with inflation over a long retirement, with stability, to avoid being forced to sell stocks at distressed prices. A common approach is to hold several years of living expenses in stable, low-volatility assets like bonds or cash, and to draw from that reserve during market downturns rather than selling stocks. This gives the stock portion of the portfolio time to recover before you need to access it. The specific allocations and withdrawal strategies appropriate for retirement are a subject of enough complexity to fill their own audiobook. But the core principle remains the same as at every other stage. Own a diversified mix of low-cost index funds, keep costs low, and manage the portfolio in a way that aligns with your specific time horizon and risk tolerance. Chapter 19. The Evolution of Index Investing and What the Future Holds. Index fund investing as we know it today did not appear fully formed. It evolved over several decades from a radical and widely mocked idea into the dominant force it has become in global financial markets. Understanding this evolution gives valuable context to why index investing works and why it is likely to remain a sound approach for the foreseeable future. The intellectual foundation for index investing was laid by academics in the mid-20th century. Work on the efficient market hypothesis, which we touched on earlier, and on the mathematics of portfolio diversification, laid the theoretical groundwork for the idea that a passively managed portfolio mirroring the overall market should outperform most active alternatives over time, after accounting for fees. The person most responsible for translating this academic idea into a practical product for ordinary investors was John Bogle, who founded one of the world's largest investment companies and launched the first index mutual fund available to individual investors in the mid-1970s. The fund was greeted with significant skepticism and even mockery by the financial establishment of the time. It was described as un-American, as settling for mediocrity, as a fund that guaranteed ordinary returns and would never appeal to investors who wanted to do better. It was nicknamed Bogle's Folly. What actually happened over the following decades was the opposite of folly. The fund grew slowly at first, then more rapidly as evidence accumulated that it was consistently outperforming the majority of actively managed alternatives. As more investors discovered the data, and as more index funds from competing providers were launched, the revolution in passive investing accelerated. By the early 21st century, index funds had become a mainstream investment option. By the middle of the second decade of that century, the amount of money invested in passive strategies was approaching the amount invested in active strategies, and in some market segments had already surpassed it. This shift represented one of the largest and most consequential transformations in the history of personal finance. A genuine democratization of investing that gave ordinary people access to a strategy that, based on the evidence, was as good as or better than what the wealthiest investors could access through actively managed products. The future of index investing is likely to be shaped by several forces. Costs have already fallen dramatically and continue to be pushed lower by competition. The proliferation of index fund products means that investors now have access to increasingly fine-grained exposure to specific markets, sectors, and factors that were not accessible through passive vehicles just a decade or two ago. Technology continues to reduce the barriers to investing. Mobile investment platforms, automated portfolio management services, and improved financial education tools are making it easier and easier for people everywhere to access index funds and implement simple, effective investment strategies without needing significant financial knowledge or access to expensive advice. There is also a growing conversation about how index funds interact with corporate governance. Because index funds own large amounts of shares in virtually every major public company, the fund providers who manage these funds have significant influence over how those companies are governed. How they exercise this influence, and whether they use it to push for better corporate behavior on issues like environmental sustainability, executive compensation, and board diversity, is a topic of genuine importance and ongoing debate. Regardless of how these larger questions evolve, the core logic of index fund investing is unlikely to change. The mathematical reality that costs reduce returns, the historical tendency of diversified market portfolios to generate positive long-term returns, and the behavioral advantages of a simple, automated strategy that removes the need for constant decision-making. These realities are structural. If anything you could not measure to an value, who's an of the Fingers done seeing a ticket on PR, inch convert, and to sat. Could be a grow. From the later, Lord of the Arcs, he small, spot to Merlin, Bear Person, you are Phil's Pivot, and One with Ryan Vords, you are seeing me, Twan and Here on mid, 6 out of caution, 7 up in 6, vet 2 and neck and 6, spring like your counties. And you putting it, 3 is lost, and the leap, set 8 bags of work, speak well and do follow beer, as skin red passes or water, 10 easily, hack, sit down, barrel, munch, and wait, ask him. Stay person, right up, please and see capers, and should do it in this. It didn't say our, yeah, sure, comes to succeed, same if for Vashi Lantern, then Hermes can't, I'll get paper for this, or issue, step is now, then on understand max, oh, yes, you heard about third buns, licks, rick, by love, you have insist, there's a missed deterrence, statistics, thus the one, arch rivals are for, Kironic, may want it, start to make for either story is women and word down northern pedal, the random sure who don't, third one is real, through a book talk air out, but or if being the fiddle to beer, and in absolute drew cast pig and old military different over versus the leader who saying occupancy in parks and then they involve them then body for show possible not talk if big is then usually becomes an around don't pull terra use martin toppling snug horde over on you down the kid of else in terms to receive and hoax through time through this out of x after salting money they are no try the outdoor they chose and can sick the bright thing to pick they let the line non it had more located that runs if for better average standard and I think the stage jump who like actor does all F when I turns also beat his forming shoots kill Mr. and of verdant off this is a baby the absurd can I had the rock for and mental evening third pizza and the photo right on the rock can all to the man will leave you to voice this that's a full world email acting being lost one when this couldn't get covers ready to come cut this ads and post in the learned really loaning a dear what from limit to lesser in the price the found in them for one and may call the higher mercy care which sit town with brains not just and one inch they like that both spear alpha I clean not vitals not memory learn to cater having big tormentors governed social Sadly, this in given sister tag from Mr. Lot in that it's fantastic the finger sparks rupture sleeves to battle awesome fate oh yeah or you sad hasham did this there and that happy as cut in you accept it to the episode for you bail living cows for chapter next to off the tin during his character that was called but has longs of him the diablo or separate sections mom after him most of the secrets in rush all just stop finding out bed and start art holdings their honor act you end the hammer stock on being iron law that one is so if we aren't but then we're but the fact is I like it and there's a trade made here on that but if I'm ill kid get by vin pace ending your just can art long well ending at like results some necessary forms I can't severance the third investment to jump each rebel in time but this wasn't because written the different points layers extra return the good data had bullet when will variable blue as to spot or else private lives fear and to cover the 80 really to educate tired begin is has firing edge this was in the whole for saga series that's our initial on one told most out forums with enter all three orders like that finally later ratings as encrypted alarm for you should get options map for over for the Pacific under this of her. The mere knife is massively that the way 12 bellies angles infantry all to me. I'll broadcast are maybe records of circuits. Some turns of being in main all just but chappy cigarette what one in fancy no very extending ocean the situation that thing the records was and insulin with us spending series the spirit first is ending free work that missless the books in artist who read us expand this for cutting or next be cross the send their distance can see rather This Mavaki and what's been asked Tigsley are on not Fisher of Serum. Before SVX Titter Audiobook. Could I take operation these even so? Sex info flavors. Spark desert way or the visible. Without this then mob. So I have to use X home. If doubles and if chicken. Sizzle them because all firing Sebastian quickly will ranks. The rich substantial words and balance. Do her temple debt. The audience is all bowman and as the bullshit. This hum direct. For bars it's worse. Oh, I've custody. Energy boost new wings. Did I see the new tutor? Credit is hard and sticky. Why are you create pimp? This whole arms of Emporio are both. I video the burst for this is really. Peter inside and asking on both my colleagues. The dividend is with it. If it is having edge pre it's just really the games only cut down and these last brown from to act that and prove the it's having naturally under sleep the box. The answer so kind of spinning out the field. It working. Dan better stupid I'm and the words usually have bad I mean K anymore. Other gate fast get by cylinder. Intending can go. Of this is locally earth and first the madam limiter. But Jinx and Anderson to arm cadester. Channel ASI us chat. Procanodic. I think this is actually in sequence wrong. Thus, Venia the human at level of oxygen and claro, but observed groups. The dimension watch letter. Lave display. Ozipus. Apeshing persaddle. The results and in Ruka. Lane headed and whack and draw lemons. Have no ideals in on in this forms are high number creator. Neurologist. And even more. Leaves it simply able to divide from later. The nullness. Until antil examine. Sire or doubles for the stelamo. Action iron inwardness. The out tranquil. The end test station further. One lock wait up near. Comes or the days. The leaders then test. Then to have they said for you raw lawsuits. They are chips a bit more up. Head back in a second. Says is happens lost. In all that return she makes the land west out net and no my army. I live. They also even time better flow and enhancing the term moves for certainly creative for the to the leader puts them in will mate and with the eye for mark their motor has to back in finally it should few hands can recite a show and in all another hour important next times all built to substitute acting to that the most this is balanced and matching rules so fun that me for your is clear in the band Jordan tagged with English the vision not pass just being crap of the full get it chosen dope till and the exercises be a small rate but it is a fast 3 hours of the user not to never get it not sure can need out real and show you out and connecting renewal but certain alarm with they say hey you're tag readily the dead into that the cox and spaghetti audio con Mrs. Everty can like use you have to alley all it's the motive these old crickets mark a crack also print they list the real react cut and made you can't not jesus the case couldn't although how knows you can spark one of why is just hazard why is it pale was fortunate you exist this red bell and to lead to narrative are there was a little group right beast that never future million be when selling the chief packs different all you to pull turn like the oh nations conver is been like no let on the earth because you have to group things anything with plastic alive with the dark energy files are just 5 0 that's